I think the kind of precondition for the equity market to stabilize is for the bond market and the rate market to stabilize, right? So we are not there yet, but we think the bulk of the rate repricing is basically behind us. And to some extent from here, the kind of narrative, the market narrative has to shift towards the kind of more growth implication from this rate hike. So the markets have adjusted to this new regime. We've seen pretty much across asset classes, sharp risk pricing lower on the back of the higher interest rate. The credit market hasn't underperformed this year. The equity market has gone down largely because of the valuation adjustment. So we think the market do reflect quite a lot of tightening in financial conditions already. Again, what we have to see now is how the economy reacts to this much tighter financial conditions. And that's why we think there is no rush to step in. Clearly you have these kind of technicals pushing up the market into the end of the year. To some extent, the kind of peak rate narrative is playing in favor of the equity market. But, comes the new year, we think we will have to see whether the economy react to this tighter financial condition. And to some extent, we think the equity market will have to absorb a recession, before looking for potential recovery in the second half of next year.
All of the above is utterly sensible, but the trouble is the markets run ahead of themselves. And I guess my issue is the eternal issue. By the time we have confidence in the data and the growth of the underlying markets and profitability, well, the market will already run away with this story. My question then, hence, is do we need to buy before we get the confidence in that economy and those strategic plans and the companies themselves? Because the market will have just run away with this story.
Indeed, and again, that's what we are seeing now. The fear of missing out is back, and we are seeing investors somewhat worrying about missing out on the upside. Now, we just like that the buying we've seen in the equity market in the last couple of weeks is very subdued. It's very much short covering, and to some extent, systematic investors, CTAs, macro hedge funds are very, very underexposed to the equity markets. They are very short, and they are basically covering the short on an improving momentum. When I see the kind of more real money equity flows, they are still extremely cautious. We are not really seeing mutual funds, retail investors really stepping in and buying equities. So I can see a lot of skepticism out there with investors still not keen to play this kind of recovery scenario. So as you said, the market will be always ahead of fundamentals, whether it's earnings growth or policy. And look, we do find this kind of move a little bit premature. The technical aspect is what it is. You always get the market up into the end of the year. And yes, less threat from a higher rate is a relief for equity multiples. But ultimately, we think the market will have to absorb this growth shock in the first half of the year. And that might create a better entry point for medium-term investors.